Welcome everyone who is joining us. Tonight's webinar is specifically for high-income business owners who feel like they're getting unprintable by the overpriced rip-off colleges. And I'm very excited. It's a brand new webinar that we're doing tonight. Have with me Mr. Rick Darvis. Rick, can you see and hear okay?
I just have a thing on my thing that says starting event. Maybe I'll have to go out and come back.
I think no. That just you're a little bit of a lag. Get a little bit of feedback though, so just turn down your speakers a little bit.
Okay.
Yes, while we do that.
Yep.
And I see people coming on. Hello, Liz. So yeah, if you're with us tonight, like Liz, who's excited to be here, please let us know that you can hear and see okay, and where you're from. We're testing out an upgraded, well, hopefully upgraded version of our usual webinar software, which is like it's been a little glitchy, shall we say. So let me just make sure. All right, so we got Nancy in Garden City, Marina, Elaine is here too. All right, so you guys, I assume that means you can see and hear us, correct? Liz from Long Island, Elaine from Chicago. All right, Craig in SoCal. Nice. Rhonda. Todd, Maryland. Okay, good. That means we're doing something right. Rick, I just lost you.
Yeah, so should I go back and try to get back in, Anna?
Yeah, that's fine.
Okay.
Do that. It might be the connection there. All right, so while Rick is re-emerging, I will no, there is audio. Okay. So there is audio. Julia asked. Good. All right, so most of you guys can hear. Hello, Polly. All right, good. Polly, great to hear about your recent success, by the way. Thanks for joining us. Polly's a client of ours and a business owner. So Rick is bopping himself back into this presentation. You know, we tested it yesterday, we tested it today, and it worked fine. And of course, you know, then all over again. So let me tell you about my mystery guest, Rick. His name is Rick Darvis. He's an accountant. He is possibly, if not he's one of the most premier CPAs who specialize in college stuff. And what I mean by that is he has, I'm just looking at his bio here, he's been quoted in Forbes, CNN, Newsweek, U.S. News, World Report, Money Magazine, Business Week, Kiplinger's, New York Times, Smart Money, on and on and on. He's actually done trainings for a whole bunch of, you name it, like every big financial firm, practically, UBS, Smith Barney, John Hancock, Franklin Templeton, et cetera, and he is a true expert. He's written a bunch of books, most notably The College Solution, which is I own it, but he actually told me that it's really a 3-volume set. I didn't realize that. He had just finished earlier today doing another presentation for a new book that he just wrote to help nurses finance their graduate education. So he will be joining us, or rejoining us, I should say. Right now he's very good looking. So it's not offending anyone. Okay, now I got bumped out. That's interesting. Very interesting technology issues here today. I'm trying to appear calm. Okay, I'm still here. Thanks, Kirsten. I feel like I'm here. But I'm monitoring this from my other monitor here. Kurt, thank you. Very odd. I wonder why I'm having some issues here. All right, well, so the stuff we're going to be talking about today, I'll just to give a little background, is I guess the best way to describe it is in financial aid. So there's a few different ways to find money for college. One of them is through the need-based financial aid system. Another way is through the merit-based system. And a third way is through, and this is mostly for business owners, through the tax system. So, so today we're really going to be talking a little bit about the first component, which is need-based financial aid, and we're also going to be talking about the third component, which is the tax system. So, the thing about it, I guess the best way for me to describe it is that it's really two opposite ways to go, meaning that in need-based financial aid planning, the object is to get money out of your kids' names. In terms of for business owners who have high income, who can't qualify, the object is to get to put money in to the kids' names. And that is that's really the gist of it. So we're going to be talking a little bit about need-based and a lot about unlocking money that's hidden in your own business. So I'm not sure what's happening with. Oh, Rick, you're back.
Yep.
Oh, good. All right. So I just went through a little bit of an overview, and I talked about some of your credentials. We are going to be giving away a prize today. Correct? You still have that ready? Yeah. So Rick's from Montana, so he's he's not a New Yorker or a Bostonian. So explain what that is, or don't explain what it is. Yeah, just say what it is.
This is a bully bag direct from Montana, and for the winner, we'll explain what it is.
Okay.
Bully bag direct from Montana.
Just like you are, also direct from Montana.
An original.
Currently you're in Sarasota.
Yep.
So, all right. So we have a slide presentation, which is going to run through like 6 or 7 strategies, I think, right?
Yep, 7.
Okay. So so we're going to go through those, and then we'll come back on the air after Rick's done with the slides, and then we'll do Q&A, and we'll do the prize.
Right.
Sound good?
That sounds good. I'm sure they're anxious to for the grand prize winner, Andy.
So it's a little bit about paying less for college and saving money on taxes, and it's a little bit of off-color humor, and that's all I'll say. Yeah. All right, you ready to go?
Right, I'm ready to roll.
All right, so go ahead with the slides.
Hi, I hope everyone can see my screen here. I'm going to put it into slideshow format.
All right, I see it.
Okay, that's good.
Looking good.
Okay, we try to look good at all times, Andy. Nothing else. Okay, we're going to look today at cash flow planning during college years, because during college years there's a little extra crunch on the family's budget, a little thing called college. Okay, so we're going to look at some planning ideas so that you can have the cash flow for college and also keep your current lifestyle. College cash flow problems. The two of the biggest expenses you're going to have in your budget are taxes and interest. And today's seminar, we're going to look at how we can reduce those two so that, again, you can keep your current lifestyle and yet send your children to college.
Great.
We're going to look at 2 ways to manage your cash flow. We're going to look at income planning, okay, and then we're going to look at debt management. With your income planning, we feel that if you can reduce the amount of taxes you pay to the IRS, that will equal tax scholarships. So instead of sending money to the IRS, you can basically send that money to the college to help pay for college. So we call those tax scholarships, basically letting the IRS pay for part or maybe even all of college expenses. The next one, debt management. If you can reduce the amount of interest you're paying to banks, that equates to a bank scholarship. So the less money you're paying to the banks in interest means that you'll have more money available to pay for college, or as we like to call it, bank scholarships. So those are 2 nice scholarships. And in addition, you may be able to, with Andy's help, look at some financial aid or college scholarships in addition to your tax and bank scholarships. Let's look at some income planning strategies. These are some basic income planning strategies that are available to a lot of families, especially those with businesses or rental property. That if you can reduce your income, you're going to pay less taxes, okay, and that will equal a tax scholarship. First one is a health reimbursement account. Basically, what this is it allows you to move your medical expenses from Schedule A as an itemized deduction, which is hard to do some years where you're, because that's based on your income. The more income you have, the less you can deduct in out-of-pocket medical costs. So in a lot of cases, people just can't deduct any of their medical costs based on their income. Basically, what a health reimbursement account does is allow you to basically move your itemized medical expenses to your business or maybe even rental property. Okay, so it allows you to basically get your full deduction for your medical expenses. Let's say your out-of-pocket medical expenses were $10,000 a year. Let's say over the 5-year that your child is in college and at a 40% tax rate, that would save you $20,000 over the 5 years your child is in college. That's your $20,000 in tax benefits or tax scholarship. There's another a $20,000 tax scholarship for you.
So can I jump in with a question?
Sure.
So let's say you're paying premiums. Like I pay, a lot more than that in premiums for health insurance because I'm self-employed. Is that something that we could use this strategy with?
Sure, you can use that, and also long-term care premiums. Pretty much any out-of-pocket medical expenses that you have. And a lot of people say, for example, your income was $300,000. As an itemized deduction, you have a 10% ceiling. So if you take 10% of 300,000, that's 30,000. And if your medical expenses were only 10,000, you couldn't deduct any of it. This allows you to deduct the full 10,000, which again would give you a tax benefit, say of 20,000 or a tax scholarship of 20,000.
Great.
Hiring your child, strategy 2. This is one that's, basic. Unfortunately, a lot of people don't use it. They think, well, what can I hire my child to do? If you have rental property, they can do, some rental fix-up expenses. They can do bookkeeping. They can do internet research for your business or your investments. I mean, there's a lot of things now that a child can do over the internet that, that they couldn't, they don't have to go out and work at McDonald's. Like typical people think, well, they don't have a job or there's nothing I can do. If you think about it, kids are pretty good on these computers these days, and with hiring your child, let's say you paid your child $12,000 a year. Now that will not cause any tax problems for the child because he can make up to $12,000 a year without any tax liability. Let's say you do this over the five years of college. College, let me just point out, is over 4 academic years. That spans 5 tax years. Okay, so that's why we're using 5 years here instead of 4. So 12,000 times 5 is 60,000 times the parent's 40% tax rate. It's going to save them 24,000 in taxes or another $24,000 tax scholarships, compliments of the IRS.
All right, jumping in again.
Yep.
So first of all, my comment is, if you're going to hire someone to handle social media or Facebook ads or something like that, I can tell you personally, because I do all that stuff, that you could easily spend a couple $1,000s a month just on that. So that strikes me as reasonable,
right?
For whatever that's worth. Are there any rules on how old a kid has to be, or guidelines, and how old is too old, and that type of thing?
Well, generally, it's the rule of thumb, I guess, or the IRS's rule of thumb is like 7 years of age. Okay. Mm-hmm. Some people say, well, my baby is models for our, like you have your college planning. You may have a 2-year-old kid there, a model. What's college going to cost for this, child in the future? Use them as kind of a poster boy or a poster child. Okay. So again, there's no really hard rules. It just got to be what's reasonable. Okay. And keep in mind, it doesn't have to be, you're hiring your child, it doesn't have to be minimum wage. Okay. If your child is doing internet research or doing PowerPoints or doing some computer stuff, that's not $8 an hour stuff, is it? You know what it costs if you're going to hire that outside. It'd be a lot more than that.
So in terms of the red flag or the downside for doing this or any of these strategies, like what is it?
As long as it's reasonable and you document it, there's no downside. I mean, this has been, this is a very common strategy for your business owners and stuff. Unfortunately, a lot of people don't take advantage of it. Again, it's got to be reasonable. That's the main thing. And there's no really hard, fast rule of what reasonable is. So, I mean, it's reasonable for picking rocks in Montana on a farm versus doing internet research in New York City. Maybe is an entirely different rate. Okay. So just. And
the documenting is just sort of like,
you document
like calendar entries.
Yeah. You just like any employee, you have to treat them just like any employee. Okay.
Great. Okay.
Or contractor. Okay. Number 3, gift and lease back. Okay. For a lot of business owners or rental property owners, they depreciate out their equipment or furnishings. Okay. And they, you've got the full tax benefit of that. That's maybe depreciated out the equipment or furnishings. So what they do is they will gift them to their child or children and then lease them back, just like you would from a leasing company. For example, if you have a copier, I have a copier in my office that I paid $12,000 for. It's depreciated out. I've got the full tax benefit of it. So if I gift that to my child or children and then lease it back from them at a fair rental rate, which I can find by calling the local office equipment store and ask them, what would this piece of equipment rent for? What's, reasonable. So basically now I'm actually deducting that again, aren't I? I am deducting that through lease payments to my kids. My kids are in a lot lower tax bracket than I am. So the difference in my tax bracket and their tax bracket will equate to some more tax scholarships. In this case, if we did a $10,000 lease for 5 years, 40% tax rate, we get another $20,000 in tax scholarships. Okay. There's really no age limit on this, like the reasonableness, because it's just what's a reasonable lease on this equipment. What's the fair market lease value of this equipment?
So in practice, let's say I'm a doctor or I'm a dentist, and I'm like, when would I use this?
Yeah, doctors and dentists, we do this a lot with doctors and dentists, their equipment and stuff. They would use it, and their kids are 2 years old if they wanted to. And they start, saving tax money that they can use to put into their college fund or for future years or during college years. So again, you can start doing this basically at birth of the kids. Okay. So you can build a nice little college nest egg, compliments of the IRS.
So let's but they can deduct equipment up to a certain point before they gift it. Or explain that.
Right. Yeah. They can deduct it all. Like my copier cost me $12,000. I've depreciated it out, so I've got the full benefit of the $12,000 in tax deductions. So now I gift it to my kids. Okay, I can gift it to my kids without any gift tax liability, and then lease it back from them. So I'm making lease payments to them. I can deduct the lease payments against my higher 40% tax rate. The children have $10,000 in lease income, but again, they're maybe at a 0 or maybe a 10% tax rate. So it's a family tax savings of, in this case, $20,000 over a 5-year period.
All right, very, very cool. And there's nothing weird about this either in terms of red flags.
You just have to have you just have to have the proper documentation. You have to have the lease agreement drawn up, and you have to have a reasonable lease. You can't lease my copier out for I paid $12,000 for $20,000 a year. Okay, it's got to be reasonable.
Okay.
So, okay, strategy number 4: education assistance program. This one has actually been in the news quite a bit lately. I don't know if many of maybe have seen the McDonald's hamburger commercials about a a kid that got accepted to college, and McDonald's was going to help them pay for it. And if you look at pretty much all your major corporations, I started looking around, most of them have an education assistance program, which basically allows them to deduct the tuition cost as a business expense for their employees, even though their employee or employees are going into fields unrelated to, like, the food business. Let's say at McDonald's is in the food business. The student that they're helping with this education assistance program could be going into aeronautical engineering. Totally unrelated. Totally unrelated. So, and again, this allows the business, and in this case, a small business owner, a rental property owner could actually use this for their own kids, okay? There's certain restrictions. The kid has to be 21 years of age or older, which maybe means their junior and senior year in college. And that's why we're just using 2 years here. Or it could be on into graduate school. So let's say in this case, you're paying $20,000 a year tuition for your child, okay, for their junior and senior years in high school, and at a 40% tax rate, save $16,000 over that 2 years, okay, another $16,000 scholarship. Kind of a nice little opportunity. Additional opportunity here is with grandparents, okay. Parents have to wait till their children are 21 or older to do this. Grandparents, there's no age limit. So if you have a grandparent that has a business or rental property, wants to hire their grandkids, and as a fringe benefit, tax-free fringe benefit, they can do an education assistance program, and they can deduct it, and they don't have to wait till the junior and senior year. So you might want to involve grandparents with this one, because that's, they want to help pay for college. Here's just a way that the grandparent can get a tax scholarship too. Okay.
That's great. So if they have an ongoing business concern, that works for them.
Right. Yep.
And they can I guess discriminate on which employees.
Yeah, you can. One of the other requirements is you can't discriminate. Okay. However, you can write the plan to say this only covers part-time or seasonal employees, which means your children attending college and just working there in the summer, or part-time, during breaks or whatever, not a full-time. So you can actually discriminate.
Got it. Cool.
So, it's a real sleeper out there, this one. But again, it's corporations like McDonald's, Walmart, pretty much all your major corporations that hire, younger kids are doing it. Okay. So if they're doing it, why can't you do it? You can, if you do it right. Okay. Number 5, this is deducting a child's car expenses. Okay. Now, a lot of you are probably thinking, well, my accountant tells me I can only deduct 50% or 60% of my car expenses because I use it for personal expense. Okay. And that's true. Okay. How can you deduct 100% of your child's car expenses? Okay. This is how it works. Let's say it costs you $4,000 a year to operate your child's car. This includes gas, tires, insurance, taxes, interest, depreciation. So in a lot of cases, it'll easily be $4,000 a year. Times the 5 years of college, times the 40% tax rate that the parents are deducting, 100%. So it's going to give them a tax scholarship of $8,000. Okay. How does it work on the child's tax return? Let's say the child uses the car 90% for personal use and only 10% to help out in the parent's business. Okay. So that means 90% of the $4,000 or $3,600 must be taxed to the child. Okay. How much tax is a child going to pay on $3,600 of income at a 0 or maybe a 10% tax rate? Not very much, right?
Right.
Yet the parents can deduct the whole amount at their 40% rate, or maybe like where you're at, Andy, 50% or 60% rate in states like California or New York. So this can be quite a bit bigger. And again, the cost of a car is probably more than $4,000 a year if you figure depreciation.
Yeah.
So that's a real sleeper there. This one.
Yep.
Okay.
Very cool.
Okay. Number 6.
I feel like you're like a magician pulling rabbits out of your hat.
No, it's just putting the Internal Revenue Code to work. This for college. Okay. Most people, I just basically try to tie the Internal Revenue Code to paying for college. Okay, through these tax scholarships. Okay, the next one is gifts of appreciated property. Maybe you have some appreciated stocks or securities, or maybe you have a depreciated out asset like my copier that's depreciated out. So in this case, let's just say we have some highly appreciated stock that we're going to sell to help pay for college. Rather than sell the stock, let's say we're going to sell the stock and it's going to have a gain of $10,000 a year for the next 5 years. Okay. At our 20% tax rate between, let's say we're in the 20% capital gain rate, it's going to cost us $10,000 in taxes. Okay. So what I would recommend is you don't sell the stock in your name. You gift the stock or mutual funds or securities to your child. Let them sell them in their name and at their tax rate, which is probably going to be 0. So your family tax benefits or tax scholarship is going to be $10,000. Okay. So I see this one as a lot because people, if you have a loser, you want to keep that because that's going to reduce your taxes. But if you have a winner or a gainer, which a lot of people do these days because the stock market's up so much, you want to do that. You could also do this with stock options. That's a little out of the realm of this, the scope of this presentation, but you can do it with stock options too. Works really well. Okay. Great.
And so this is just basically for regular stocks. Does this work for mutual funds or is
sure,
that?
Mutual funds. Yeah. Any asset. Okay. Could be land that you bought 20 years ago. Now it's highly appreciated. Why sell it in your name, pay a bunch of tax, gift it maybe over a series of gifts to your children. And then they sell it, pay 0 tax.
Terrific.
Okay. The last one is claiming education tax credits. There's some tax credits out there, the American Opportunity Tax Credit, which reduces your tax liability on a dollar-for-dollar basis. It's not a deduction, it's an actual credit. Okay, it's $2,500 a year for the first 4 years of college. And then there's a credit called the Lifetime Learning Tax Credit for the 5th year of college. Because remember, college is over 5 tax years. 4 academic, 5 tax years. And that's $2,000. And that credit also can be used for graduate school. But in this case, we're just going to figure it for the 5 tax years of undergraduate. So your total tax credits could be $12,000 per child. Now, the sticker here is, or the problem a lot of people run into is the parents can't claim this credit if their income is over $180,000 on a joint tax return, which in a lot of cases, especially in the New York area, doesn't take much to get over $180,000. So the parents can't take these credits. However, that doesn't prohibit the parents from taking their child off their tax return. You just simply remove your child from your tax return. Now the child can claim these tax credits to offset some of the income that the child has. And if you remember in the prior 6 slides, we've been shifting a lot of income through wages and gift and lease back and the car and the education assistance plan to the child, right? They might have $30,000 of income and they may have a tax liability. However, they can use these tax credits to offset the tax liability. So in effect, the family is still getting full advantage of these $12,000 in tax benefits.
And this, I don't know if I'm going to say this the right way, but you're accounting for netting off whatever deduction they had for declaring them as a dependent,
right,
versus the separate tax return and the costs and the payroll.
Yep. Yes, it is. Yep, it is. It's a lot. That's a big benefit. Okay.
What if they take, like a lot of kids take like 5-6 years to get out of college? Do the tax credits extend for those extra years too?
The American Opportunity Credit, the $2,500 one, is only for the first 4 years. The
Okay.
$2,000 one can be, if the kid goes to college for 15 years, you can take it for 15 yees. Or
God
they go
forbid.
back to college, they may get out of college, go back 10 years from now, you can take that credit. So,
Okay.
yeah. So,
Yeah, those are great.
yeah, and some parents go back to college maybe so that there's more than one in college at the same time, and maybe some financial aid benefits of doing that. They can basically claim these credits to help pay for the cost of those credits, right?
Yeah.
Okay. So that's pretty much the income. Now, let's look at our total tax benefits. This is kind of a summary of the tax scholarships we've gotten over these 6 or 7 strategies. We have total tax benefits or tax scholarships of $110,000.
Yeah, that's insane. But I just want to say that we've gone over a bunch of cases together, including Pearl and I, our own personal situation, and this is not an exaggeration or unusual.
No, it isn't. Believe me, it may be understating.
Yeah, if anything.
This is per child.
Yeah.
If you got 4 kids, take that the 110 times 4. Right? So
I'm not getting them all cars, but yeah, other than that.
Okay. Yeah. So that's the tax income part of it. Okay. Now let's look at debt management. Okay.
Yeah.
Because interest was the other big gorilla in the room as far as, what can, cramp your lifestyle while you're sending kids to college. It's interest. It's cash flow, right?
Uh-huh.
So let's look at a simple concept called debt consolidation. It's a very simple concept, yet very few people use it. Okay. Let's say before debt consolidation, we have our monthly payments. We have our mortgage on our house. We have car loans, $1,200, credit card payments, and a business loan. So our total monthly payments are $6,000. Our total debt, the balance on our debt of these 4 loans is $633,000. Okay. Now let's say we consolidate the bottom 3 debts: the car loan, the credit card, and the business loan. We refinance the house or do a second on the house. We roll them into a home loan, which usually is your best type of loan, interest rate wise and term wise. Okay. So now, after consolidation, we have a monthly home payment of $4,000 instead of $2,800. We have $4,000, and we have a mortgage balance of $633,000, which is the total of the prior home balance plus the car loans, credit cards, and business loans. So we basically.
Sorry. So just to jump in, so that's by taking out like an equity line or
right,
something,
or a second mortgage, or just refinancing, because a lot of
Okay.
people are doing that now because of the interest drop in interest rate. So it's
Yeah.
the perfect time to do that and just roll some of your other debt in there.
Okay.
So after consolidation, our monthly payments went from $6,000 to $4,000. We still owe the same debt amount, right? Still owe $633 in total, but we've dropped our monthly payments from 6 to 4. Okay, that's $2,000 a month over the 5 years of college. That's $120,000 in extra cash flow for college. Now, a lot of people are thinking, well, yeah, but you've just, you've still got the same amount of debt, and over time you're going to pay a lot more interest. Well, stay tuned. We're going to show you how to pay off this $633,000 and save a lot of interest. Okay, so let's look and see where we're at now. We had our tax savings or tax scholarships of $110,000. We just now freed up $120,000 cash flow through a debt consolidation, and now we have $230,000 over the 5 years of college available for college. Okay. So we're.
By the way, so I'm just like everyone else who's probably thinking and watching while they're watching this. Like, these numbers are insane, and they're almost too good to be true. So definitely continue. I see some questions coming in. Definitely continue to ask those questions, and I will be moderating those. And once we get through the next couple of slides, we'll start answering those. We, meaning Rick, will start answering those questions.
Yeah, people say a lot of these look insane. These don't look right. Well, there's a reason Warren Buffett, Bill Gates, Mark Zuckerberg, and Jeff Bezos are in a tax rate that go from 8 to 11% maximum. Okay, you consider your tax rate compared to their tax rate. You talk about insane. Well, what is more insane? Those people paying at 8 to 11% and you paying 40, 50, 60%?
Yep.
That's what's insane.
Yep.
Okay? But they take advantage of some of the things that we just showed you. Okay. Okay, let's look at that debt. Okay, we talked about debt management. Okay, we consolidated our loans into one debt, $633,000. Let's say we refinanced our mortgage. We now own $633,000. It's a 30-year loan at 6.5%. Why do I use 6.5%? Because maybe that could be a student. This could be a student loan, right? A lot of people have student loans of this much or more when you consider sending 2 or 3 kids or 4 kids to these private colleges. Your federal plus loan rate, Andy, is a little over 7%, isn't it?
Yeah, now it is, yeah.
So it's just outrageous what the debt these kids are coming out. So this doesn't, it could be a mortgage or it could be student loan plus loans, right?
Right.
Okay, so we'll use the 6.5 because it comes out to a nice round monthly payment of $4,000 a month. Okay. So now we're going to show you how most people will pay this $633,000 out. The conventional way of paying debt. They have a checking account. They put their income into it, whether it's wages or income from their business. Let's say it's $14,000 a month after taxes. Okay. They have living expenses, food, clothes, insurances of $8,000, and then they make and that comes out of their checking account, right? And they make their monthly mortgage payment. So at the end of the month, they have excess cash flow of $2,000, which is their income of $14,000 minus expenses of $8,000, living expenses of $8,000 minus the mortgage of $4,000. They have $2,000. Now, what do they do with that? Most people, they let it sit in the bank account. How much rate of return do you get on your bank account, your checking account these days?
It's insulting.
Yeah, it's insulting. Pretty close to zero, right?
Yeah.
And in 30 years, you will have paid it off and you will have paid a ton of interest and there'll be a new bank building going up in your neighborhood. Okay? That's how it works. That's how it works. Okay? Now, let's look at a different way of paying that loan mortgage off. I call it the cash flow maximizer, how to get out of debt faster. So instead of making payments to the bank for the next 30 years, you can only make bank payments for maybe 12 years, okay? And then put the rest of it in your pocket, okay? Or use it to pay off student loans or whatever, or just have a good time. So let's say month 1, it's January 1, your New Year's resolution is, I'm gonna borrow through a line of credit on my home, $24,000, okay? And what I'm gonna do is I'm gonna apply that to my mortgage. And I'll reduce my mortgage by $24,000. Now you say, well, what's the big deal here? The interest rate on the line of credit is 6.5. The mortgage is 6.5, so that's the same. Sure, I have $24,000 less debt on my mortgage, but I owe $24,000 on my line of credit. So what's the big deal here? Well, let's just hold off on judgment on this till we show you a couple slides here. Okay, so now we're going to do just like conventional method. We put our income into our checking account, right? $14,000. Take our living expenses out. Take our $4,000 out to pay the debt to the mortgage. We have $2,000 excess cash flow, just like before. Instead of letting it sit in the bank earning nothing, we're going to apply it to our line of credit. We're reducing a $24,000 debt down to 22, right? In effect, that's giving us what kind of interest on our money? 6.5, right? Versus nothing. Okay. Now, going back to that debt consolidation we did, we consolidated the car loan and the business loan and credit card loan into our mortgage. We created $2,000 a year extra cash flow, right? That we could use for college.
Per month, right?
Per month for college. Now, let's say this is after college years. Would we have this excess $2,000 if we wouldn't have done a debt consolidation?
Nope.
Nope. So and with that money, we're going to pay off that line of credit. Okay, so that's month 1, January. End of January, owe $22,000. Month 2, it's February 1st. We're coming in owing $22,000. We go through the same cycle. We put our income in our account, and we take our expenses out, and we make our mortgage payment. We have $4,000. We have excess cash flow of $2,000. We apply that to our line of credit. So I think you can see where we're going here. By month 12, December, we're going to fast forward to December. Going into December, we owe $2,000. At the end of December, we owe $0 on our line of credit. Okay. Let's look at month 13. It's January 1 of year 2. What do? We start the cycle all over again. We go borrow $24,000, put it on our mortgage, and start paying it down $2,000 a month, right? Okay. Now, if we do this, okay, how long is it going to take us to get out of debt, out of that 30-year loan? Well,
A lot less.
Here's
Wow.
our summary. Our summary. Between year 12 and 13, we will be out of debt using this method. Our neighbor, who has the same debt of $633,000 starting, will still owe $493,000.
Wow.
So we can, at this point, start putting this money that we were paying to the bank, right, at $4,000 a month to the bank. We can start putting that into our retirement or have a good time with it, right? Or paying off student loans or whatever. It just feels a lot better to be out of debt in 12 to 13 years, especially if when you incur this debt, you're say 55 and you've got a 30-year loan that you're going to be paid off by age 85, right?
Yep.
I always ask them, when do you want to retire? 65? I want to retire at 65. So that means you're going to be paying.
How about 5 p.m.?
Yeah. So now you're going to be
Friday.
paying on a mortgage 20 years into your retirement.
Yeah.
How's that going to work?
Yeah.
You're
Rethink
out
that
of
one.
debt, going out of retirement. Okay. So then here's kind of a little summary also of the 4,000, the conventional way versus the cash method, the cash flow method of paying off, cash maximizer method. Okay. Here's our total payments, $1,440,000 versus conventional versus our method, the cash flow method. Interest, $807 versus $293. You're paying off the loan in 12.83 years. Okay, your interest savings is $513,000. Okay, but what about that interest on that line of credit? Remember that $24,000 we're taking out each year for those 12, 13 years? That's 6.5%. The total interest over this 12.83 period on that line of credit will be $8,592 is all.
Because you're paying it back so quickly each time.
Right, you're paying it back. You're amortizing it. Okay. So here we have interest savings of $505,000 even after the line of credit. So this is how you can afford to pay for college and still keep your lifestyle when you combine tax strategies with interest strategies to get tax scholarships and bank scholarships, which hopefully will not hurt anybody's feelings that the IRS and the banks are paying for your children's college educations.
Yeah, that's not terribly offensive.
Okay, so I'll let you talk now, Andy, on what the next steps are.
Yeah, so we'll I guess we should shut down the slides here, and then we'll take some questions. And if anyone wants to talk to Rick directly, there's a button here that we're going to put up on how to schedule a time to talk about tax scholarships and bank scholarships. It's that little blue button here. But why don't we come back on screen now? Okay. Rick, you're back. I don't hear you. That's disconcerting. Is your microphone on? You guys can hear Rick. Sometimes when we switch back and forth to the slides, it gets like a little goofy. Rick, is your mic on? Yeah, we can't hear you, Rick. You want to let's see, maybe come out and come back in again, like you did in the beginning of the thing? Yeah, I can't hear you. See your lips moving. All right, so Rick's going to come back out and come back in. But you guys can hear me okay, right? So I see a lot of questions here. A lot of questions about some of the nuts and bolts type stuff. Yeah, okay, so we definitely will get through a lot of these. I definitely want to ask Rick about the risks involved, because I think I told you if you read our emails, we're actually clients of Rick's, and I went through a lot of this due diligence stuff myself first before I wanted to open it up to my actual clients and people on my list. So, but I want to make sure you guys can hear me. So Elaine, you said no audio from Rick, but can you hear me? Just making sure. Looks like everything's fine. But what do I know? Sabine, you can hear me. Okay, good. Hi, Sabine. So if you are interested, I'll just go through this right now before we get into the Q&A and then the contest, which I promise you is worth it. The prize is worth it. Thanks, Elaine. Okay, good. So So Rick's a business consultant. He's also a CPA. Those are basically two separate businesses. He's not looking to steal anyone's business from your current CPA. That happens a lot just because most people realize that their CPAs aren't really getting the job done. But what he is a business consultant. So around here in New York, we have these guys who grieve property taxes, which is sort of like being an attorney. Sometimes they are attorneys actually, or an attorney who works on a personal injury case or something. They take a contingency. They take a percentage of the fees of in Rick's case. So I'm going to put that up right now. In Rick's case, what he does is his fee is equal to a percentage of the savings that he creates. So So the way it works is if you are interested in talking to him one-on-one, you would apply, meaning give us some basic information, really, Rick, and that's all on that blue button right there. Rick's coming back on, it looks like, and you would just and you can click on it. And you're not gonna leave the broadcast because it's gonna open in another window, and you just give us some basic information. All right, Rick. Can you hear me? Okay.
Right.
All right.
I'm back.
Yeah, it's good.
Like a bad habit, you can't get rid of me.
Like a rash. So I was actually just before we get in the Q&A, I was just going through how people can talk to you. So you just chime in. But the gist of it is you fill out that application by clicking that blue button. Rick will eyeball your information just to see if you are actually a good fit. There's no charge for that review. He will then, if he thinks that you're potentially a good fit because you're going to give some basic information, you can provide your page or two of tax returns. You can cross out the social security number and anything else that you want, just so we can get a feel for it. And then he'll contact you if he thinks that he can possibly help you. And then you'll go through the strategies, with him. Rick, do you usually do it the way you did it with me and Pearl, just by kind of doing a screen share and looking
Right.
at
I basically would have their tax return, then I go through it. I read a tax return like doctors read x-rays, so I can see certain things and then point out some strategies that are available, and then it'll be up to them whether they want to implement them, or not. And again, if they want their own accountant to implement the strategies, that's fine with me, so.
Good. Okay. So all I was saying was that there's no risk because you're kind of putting your money where your mouth is, more than I certainly would. And and then if they do decide to move forward, then you take a contingency, based on the savings, which we'll go over in writing if you think it's appropriate, and all the other stuff. But that's just the gist of it. So I was going over that just while you were coming back on with the audio. So can I give you a few Q&As here, or Qs,
Sure.
and you can respond with the A's.
Yep.
So we had a few questions about I guess overall about the risks. You know, I mean, I'm paraphrasing. I'm combining a few questions. I think Susan asked about, have you ever had to defend any of these strategies? How aggressive are they? You know, what's the downside if someone, you know, does one of these or a combination of these strategies? What could happen? What could go wrong?
Well, yeah, there's always the risk that you're going to get audited, and that's the big scare that the IRS, you know, loves to scare people into not doing things. So, again, they can scare you into keep paying your 50% tax rate, or you can implement some of these strategies. The thing is, if you do it the right way, whether it's with me or your accountant, your CPA, your tax accountant, if you document it, do it the right way, then there's, you know, you're audit proofing it. So, and I have sent Andy the documentation guide or the implementation guide, and I think it's fairly extensive. It gives you the forms, everything you need. And again, you can implement it, or you can decide maybe one strategy fits yours better than another one's. But yeah, it's, I guess, you know, there's no guarantee in life except one. I guess we know what that is, but you know, there's no guarantees that you're not. And again, if you get audited, you know, if you have the right documentation and stuff, then there's no problem.
Right, and I think that's important because it's not; these are not some like fast and loose. I mean, I can tell you as an attorney, and I ran this by several of my friends and my own accountant and whatever, and none of these is
no
raise an eyebrow at all. It's just, but
right.
It's all about being legitimate and documenting everything.
And your accountant knows these. The problem is, and I don't want to be too disparaging on my fellow CPAs.
Yeah,
they just are not proactive in letting you know this. Okay. I always ask people, when's the last time your accountant called you in the middle of summer and said, I have an idea that can save you some taxes? They know these strategies. These are Internal Revenue Code sections, stuff like that. They know the strategies. They just need to be, I guess, maybe prodded a little bit to be proactive and to actually implement them. Okay. It's the implementation where a lot of them fall down.
Yeah, I think that's the understatement of the night. Okay, so what happened? Okay, so I have a few questions for you too before we get into your contest, and then we're going to go through everyone else's questions. But Polly was saying that she clicked on the blue button to sign up for the free tax scholarship strategy session, and that caused the webinar to freeze, which is weird because I'm doing it right now myself on my other laptop and it's not doing that. So Rick can handle, you know, we said before 11 people to do this. So Polly, you got one of those spots. And again, he's, you know, not, I guess some people won't be able to be helped. So who do you think you can't help, or who should not reach out to you for this type of help that you described, these strategies?
Well, basically, these strategies are basically designed for people that have businesses. You know, whether it's retail business, it could be a professional, someone that has a doctor, a self-employed doctor. It could be a realtor. It could be someone that has rental property. Okay, or it could actually be someone that is a partner in a partnership, where you don't want the actual headache of running a business. You have other partners that do that. You can actually use these strategies there. It's also on your individual tax return, so it doesn't affect your partnership. So, and again, it's mainly your business owners, but again, that's who you can help the most. Just like anything, you know, business owners they have a lot of tax breaks. They just need to, you know, implement them.
Is there a certain income level that's better than others where you see it work, or, you know, a ceiling threshold?
No, not really. I mean, you can have someone that's self-employed making $100,000 a year. Their tax rate, when you figure maybe 12% federal, 15% self-employment tax, maybe 5% state tax, you're at 40%. Okay, right there. And you can implement some of these strategies. Keep in mind, at that income level, it's not only going to help you with taxes, it's also going to help you with financial aid, as you well know, Andy.
With us. Yeah.
With you guys, you want that income as low as, you know, reduced. In some cases, there's a bigger financial aid benefit than a tax benefit of doing these strategies, because your financial aid is income-based most financial aid is based on your income. And so if you're reducing income, you're going to get a double benefit during tax years or during college years. You're going to get tax reduction plus increased grant and scholarship and financial aid for your student. And the third benefit is under the Affordable Care Act,
Yep.
Also based on your income, where your average premium for a family of four now is, $2,600 a month across the United States. And that's also based on your income. And it's quite shocking if you can lower your income by, in some cases, I've seen by lowering your income by $10,000 using some of these same strategies we looked at tonight, their health insurance premiums dropped $20,000 a year.
That's real money to me. Where did you learn all this stuff? I mean, I don't think I even ever asked you that. I know you've been around the block.
Basically,
yeah.
I used to give seminars in over 40 states to state CPA societies, and I actually would network with a lot of the top tax professionals. I'd trade them college advice for tax advice. I basically tied the Internal Revenue Code to college because, as we said earlier, college grants and scholarships are not based generally how smart your kid is or how talented. It's based on your income, and that's what accountants do, right?
Yeah.
And I can't sell these strategies are mine. They're from a collection of some of the top tax professionals in the country, and I guess just through experience, I guess.
Good. All right, so let me get into these questions because there's quite a few. Just some ones I see right now. So Anthony, please extend time for the offer because the button issue you can't. Okay, so yeah, no problem. I think that'll stay up. And if not, then just email me directly. All right, so let me start from the first ones that were flagged as questions here. We'll be sharing this PowerPoint later by email. We'll talk about that. I'm trying to record this presentation, so hopefully with the technology it worked. All right, Polly, is the HRA something that can be done with just the owner of a business? I think she means HSA. I was told an HSA had to have multiple non-owner participants in the business. Health savings account. You have
to. Your HRA, health reimbursement account.
Oh.
Okay, that you have to cover all the employees if you offer it. You can't discriminate. So it basically fits the mom and pop operations. Okay.
Okay, and so she also said HSA, but maybe she meant HRA. Health savings account.
Well, yeah, and that's got to be offered non-discriminatory. So
got it. Okay.
Again.
So you
they
can't
don't fit everybody. Okay.
Okay. All right. So Nancy was actually a client of ours. She had a question. I actually think I might be able to answer this. So when you shift income, I guess this is back in the beginning, we were talking about shifting income to the kids. And Nancy said, doesn't that now count as income to them? And aren't they penalized more for their income or assets? Well, in a vacuum, the answer is yes to both of those. But I think what you were talking about are examples where people aren't going to qualify for need-based aid anyway.
Yeah, depending on where your child's going. If your child's going to a public school, and even if you do qualify for financial aid, what are you going to be awarded? Debt and a job, right? That's
Loans,
not
yeah.
very. I'd rather have a tax scholarship. And also keep in mind, I think at least Andy realizes that the financial aid assessment rate on a parent's income is 47%. On a child, it's 50%. So by shifting income from a parent to a child, we're only losing 3% in financial aid eligibility, but we may be gaining a lot of tax scholarships. Okay, so a lot of, I guess, financial aid experts just honed in that we got to keep the kids' income at $6,000-7,000, and that necessarily could backfire on you. And a tax scholarship is not a loan or a work study, is it? It's real money from the IRS.
Yep. That doesn't have to be repaid. Okay. Richard says, is there a restriction on using home or business financing to cover these costs? Or does it vary depending on the type of entity the family is running?
No, there's no, the different entities. Okay. These strategies, pretty much every one of them will work with any type of entity. Okay, the hiring the child, you might have a problem if you're running it through a corporation, because then you have to pay payroll tax on them. Whereas if you were running it through a self-employed business or a sole proprietorship or a mom and dad partnership, okay, then you don't have to withhold or pay payroll tax until the child reaches age 18.
Good. Yeah, I hear that a lot. Okay, here's another one that I hear a lot from Anjali. Do I have to file their return, the kids, if the child is making less than $12,000? Is there a magic number?
Yeah, I got that question the other day. In fact, it's kind of a difficult. It depends on the type of income. Let's say the child has some 1099 income. It's nothing withheld. Okay, then there's even at $400, he gets a 1099. He has to file because he'd have to pay self-employment tax. He wouldn't pay any income tax, but he could be subject to self-employment tax. And that starts basically at $1. Okay. And also there's another reason you might want to file. Maybe there's withholding and the child might want to get a refund. Okay. So, but again, with some of these, it just depends on the situation. But the $12,000 and actually it's on up to $12,200 is the standard deduction for earned income. Okay. Now that's earned income from wages. Now it's a little different story if your income comes from interest or dividends. Okay. Then it could be taxed at the parent's rate. Okay, so it's not as simple. So again, I strongly encourage you, if you're going to do this, you work with your tax accountant, or and that there's no real definite answer. Just depends on the situation.
Yeah, and I always was wondering, and Pearl also, why can't we ever get a straight answer? And you explained why. So
yeah,
we have that question.
It's not that easy.
Yeah. Okay. Well, you guys from Montana guys, you're a little shifty.
Yeah.
So we need to go to your contest here, your question. But before I do that, so we've gotten a bunch of submissions already from some people who managed to successfully click on that blue button. I just posted the actual direct link. If you want to fill out the application for what we call the tax scholarship strategy session. And all it is again some basic information, page or two of your tax return. You can go ahead and redact everything if you're or send a password protected and email the password separately. And Rick will take a look at it. If he thinks that he can help you, then you'll find out exactly how and the contingency fee. But it's a free look. There's no risk. He's putting his money where his mouth is. It's pretty awesome. All right, Rick. What's your so you'll say the. Right, you will do the the question, and then the first person to get it right in chat. Okay. Typically, when I do this, it's been a while. There's a whole flurry of people doing this in chat. So, so I'm not going to review it right now tonight. I will log in tomorrow and download the chat and figure out who's the best, who got the answer first, and then we will contact them to award the prize. So, those are the rules. Right. You ready with your big question, your big challenge?
Okay. First question is, believe it or not, Andy, I'm a lifetime Yankee fan. I remember it broke my heart in 1960. I was in fourth grade listening on my little transistor radio to the World Series. And you know what happened in Game 7? They're playing the Pirates, Bill Mazeroski.
Yeah.
It broke my heart. So I'm a Yankee fan. So the first one is a New York Yankee question, okay? Since I'm assuming you're in New York, Andy, you'll probably get this right away. Who did Lou Gehrig replace at first base when he started his consecutive games played streak? Who was the first baseman that Lou Gehrig replaced?
Wow. All right. Well,
could be an easy one for a Yankee fan out there.
Yeah. Number one, I don't know how you were a Yankee fan in Montana. I mean, although I guess you had no one else to root for.
I know. The Minnesota Twins weren't around at that time, or Seattle Mariners, or.
Number two, it has nothing to do with taxes or college, so I appreciate that. And number three, I'm a huge Sox fan growing up in Massachusetts.
Oh, wow.
That really hurts. Yeah. I don't know the answer.
It's too bad.
Yeah, the Iron Horse, though. I do know who's the Iron Horse.
Did anybody get it yet?
Well, we see a lot of answers coming in, so I am going to again. I do think I see the right ones, but we will absolutely contact. I'll review the chats tomorrow morning.
Should we check and see are the initials of the player WP?
Yes.
Okay.
Yes.
I had my other one. The one was going to be from Montana. The next question is, what was Roy Rogers' horse called?
Trigger. I know that one.
Okay. And that's also the third one.
Yeah.
What make and model car is this? It came out the year I was born. Okay, it looks like it could go frontwards or backwards, right? You can't tell it's going frontwards or backwards.
Huh.
That was the year I was born. I'll give you a hint. The model was a Starlight Coupe. And it was,
you were born in the horse.
A convertible version of this. Convertible of this was shown in the Muppets show. It was yellow.
Okay.
Same make.
A lot of trivia there. Well, at least it wasn't a horse and buggy. That was
Okay.
my guess. All right, so let me go through some more of these questions here.
Oh yeah, they got to know what the bully bag is, though, right?
Well, let's go through the questions, then we can tell
Okay.
them. We have a lot. We just have a lot to go through here, and
Okay.
you're being very childish.
Okay.
All right, Polly, can the child who's paid apply for the learning credit on their taxes?
What was that question again, Andy?
The child is getting paid. Can they receive the learning credit?
If the parents take them off their tax return.
Okay.
Okay. In a lot of cases, that's the case. Like Bill Gates can't claim the lifetime learning tax credit or the American Opportunity. His income is too high. You take the child off the tax return. That will enable the child to take the credit.
Good. Okay. Mitch, what about the payroll taxes on hiring the child, like FICA and disability and whatever? Like I guess he's asking what's the net?
Okay, yeah. You have your payroll tax, okay. If the child is under age 18, if you're self-employed or you have a mom and dad partnership, there's no payroll tax. If it's through a corporation, S or a C corporation, there's payroll tax, okay. So it just depends where you hire it. For household work, let's say you're hiring your child to mow the lawn or babysit or do some other household, its age is 21. So that's a consideration. The payroll tax, it's deductible, but that is a consideration. But when you figure the payroll tax versus the parent's tax rate, maybe 50%, maybe more. And if you're self-employed, okay, if you're paying your child, you're reducing your self-employment tax by the same amount as the child could potentially paying on there. So it's a wash. Instead of the parents paying it, the child is paying it, but it's a wash.
All right. So we got a few questions about that relating to the income shifting. Works the same way with the sale and leaseback, or the gifting and leaseback of equipment. Same concept.
Right. I mean, one thing about the gift and leaseback that I like is there's no payroll tax.
Right.
Okay, that eliminates the payroll problem. Plus, with hiring the child, there's the reasonableness, and we talked about that. How young can you hire a child? IRS allows as young as 7 years of age. So there's a reasonableness of wages, and what are they doing? But with gift and leaseback, all you need is get a quote from your local car dealer or equipment dealer, copier dealer, or whatever. What would this rent for? Now, and again, so it may be in some ways a little cleaner.
What can a 7-year-old do for a business in your experience?
What can a 7-year-old do?
Yeah.
Just depends. I've had some people say, well, my kid is a model for my business. Okay. Yep. Or Gerber, you've all seen the Gerber baby food ads, right? With the copper tone tan. In Montana, again, it's a little different area out there, but at 7 years old, I was picking rock and hauling bales and stuff like that. But I mean, it just depends. And these kids on this internet anymore, they know more than I do. So, I mean, it's got to be reasonable, and that's why you need to, maybe talk to your accountant or maybe do the gift and lease back until they get older.
Listen, I'll tell you right now, I have a internet marketing consultant that I pay, and he cut me a deal, and it's it's an inexpensive, relatively inexpensive proposition, but it could have been many thousands per month easily to do stuff that probably the average 16-year-old could do.
Right. No, I mean, it's, again, a lot of people say, what can these kids do? I'll tell you one thing. They're pretty good at research. Internet research is a big one. My kids, especially in college, okay, they're not even there. They're doing PowerPoints for me. They're doing research for me. It's this internet. I mean, you don't have to be physically present anymore.
Yep. All right. So Richard asked a question about if CPAs are unfamiliar with these strategies or don't believe they're legal, or I guess have any objection, can Rick handle the planning and return for a fee? If so, what's the typical fee? So what I said was, I don't want to put words in your mouth, but you've told me this. You're not looking to take anyone's business, any CPAs.
Yeah.
But the business consulting, you do that on a contingency. That's a joint venture that we have here. But you certainly can do the returns also.
Right, if they want me to, yeah. I mean, it said if they're legal, their accountant believes they're legal. They're not illegal. That's what you will run across is, well, that's not reasonable. Okay, maybe it's not reasonable, or it's not a reasonable wage or whatever, but it is legal. Okay, I've given seminars in over 40 states to CPA societies. I've networked with the top CPAs in America, and tens of thousands of them from New York to California and in between. I think someone would have said something by now to me that they'd have put the hook on me and pulled me off the stage. So they're legal. It's just they got to implement it. You got to do it, because if you don't do it, if you're not proactive, you got to realize the accountant works for you. You're paying him. Okay. The answer I don't like, if a lot of accountants say, no, you can't do this, no, you can't do that. Well, then you tell me a way I can do it. That's the answer I want.
And I'll just chime in for what it's worth. Again, as a recovering attorney, one of the things about the planning document that I had, that I have when we hired you, is you cite all the rules and regs. All the
right.
You say specifically where the authority comes from. So it's never about legality. It's about an opinion that's sort of based on sort of gut visceral reaction type stuff, not thinking about a way to get to yes, as opposed to just shooting it down because it's
Yeah, it's too easy to say no.
Yeah. Okay.
Too easy to say no.
All right, Harris, is there a limit on what you can pay a year for an educational assistance program? And is that, by the way, we had another question. Is that a Section 127 plan, or is that?
Yeah, it's Internal Revenue Code, Section 127 for those that like Internal Revenue Codes. Okay. Your accountants know about them. The problem is most accountants don't use it for small business because there's what they call the attribution rules, which means that your child can't own more than 5% of your business. And say if the parent owns 100% of the business, the child is attributed to own 100%, except the attribution rules go away at age 21.
Ah,
okay. And it's a reimbursement, and it can be used for undergraduate and graduate school. And is there a limit? As far as deducting it, no. Okay. Let's say tuition's $30,000. Okay. The business owner or the parents can deduct the $30,000. Okay. So they get a 100% tax deduction. As far as the student's tax return or the child's tax return, the first $5,000 is tax free. Okay. So of the $30,000, the first $5,000 is tax free. The extra $25,000 is taxable. Okay. Considered earned income to the kid or the child. That's going to cause them some taxes, right? Because it's over the $12,000 standard deduction. But what does the child have maybe available to offset the tax liability? Okay. Remember we talked about the American Opportunity Tax Credit and the Lifetime Learning Tax Credit. So basically wipes out his tax liability. So you utilize those credits for, the parents can't take it, the student can, or the child can. So it's a family tax savings. Okay, so that's
good. You're able to do returns in any state or
any state. I do tax returns in pretty much every state in union. I can tell you which states. New Hampshire is probably the most screwed up one I've ever run into. Which is? Yeah, it's crazy.
Which one?
New Hampshire. I mean, I don't know. There's weird stuff going on in that state because I have clients basically in a lot of different states.
Okay.
I mean, it's.
Does it matter? Well, actually, I think I know the answer to this. Do these strategies work regardless of the business structure, whether LLC, S corp, or C corp? I think
Yeah.
you recommend it.
Yes, they do. You know, they do. They all work. You know, some entities better than other entities. You know, but they all will work to some degree.
Good. All right. So Susan asked, she felt that some of these strategies seemed aggressive, and look, they're not right for everyone, and I don't personally take them as aggressive, but I think of them as creative,
Proactive.
Have you ever defended these ideas to an IRS agent?
Oh yeah, all the time. I mean, they're not aggressive. Believe me, they're not aggressive. They're proactive. Okay, they're not. There's nothing here that isn't in an Internal Revenue Code section. There's nothing. Okay, that isn't. As long as you have the proper documentation, okay, and it's reasonable, then you'll have no problem.
Good.
I know the IRS loves to scare people into staying in their 50% tax rate.
Honestly, when I get an email, when I get a letter that's from the IRS, I always like have a little pit in my stomach. And it's like lately, it's just we changed your address or confirm you changed your address. I mean, even though I didn't change it, it's like it is. That's
scary. About the time you yell, "Pearl, take care of this."
That doesn't always go so well, as we've discussed. All right, Rhonda, can you have both health reimbursement account and a healthcare savings account?
I don't think you can. No.
Okay.
Because yes, you can. Yes, you can. They changed. Yes, you can. You could actually have the health savings account. Okay. For some of your expenses, and the other you may just never use the health savings account. You may never use it. You may, keep your money in there because you're hopefully drawing a return on your money, and you use your health reimbursement account to pay your actual expenses. So you're just building up money in your HSA.
Okay. We got some very specific questions about which mortgage should you pay first, primary home or rental property. I don't think we shouldn't answer that one because that's too specific, and you probably don't have enough information for that. But if you want to talk to Rick, go ahead and do that application. Kevin, the CMM strategy seems the same as just paying more each month to the mortgage. Why line of credit versus just paying down the mortgage directly? Well, I think it's a cash.
Or you could borrow money from your credit card as long as you pay it back at the end of the month, right? You could borrow from your 401k, okay, and use that as instead of a bank line of credit. Or you could just take it out of your savings, or just take it out of your monthly thing. But I think one of the big advantages of it is it shows you the pot of gold at the end of the rainbow, and it kind of gets you disciplined to do that. Okay, I mean, it's not magic; it's basically taking advantage of, an
arbitrage, right?
Arbitrage, yeah. I mean, the biggest advantage is it kind of gives you a little more discipline in your life if you know that I'm going to have $500,000 more in my pocket in 12 years.
Yeah. All right. Anjali, I see lots of people from Long Island. Any recommendations for a good CPA to do taxes? Yeah, Rick. I mean, mine retired and I can't find one. Okay. Elaine's response was, I dislike my current CPA. Okay. Yeah. Elaine's having a problem with the form. All right. Just email me privately, CEO at lockwoodcollegeprep.com. I mean, it worked for me, so I don't know what to tell you, but sorry about that. I mean, I see a bunch of people. We've gotten like 9. But we have 10 people who already submitted it, so it's working for some people. Won't hold it against you. Just email me directly. Polly, is an HRA and HSA the same thing? You already answered that one, right?
No.
Harris, is there any advantage or disadvantage by paying your child as a 1099, I guess, as opposed to a W-2?
It gets, I guess the advantage, like people would say, you don't have to pay payroll tax, but then the child, on the other hand, has to pay self-employment tax, so there's really no advantage. Plus, it's pretty tough to say a child that only works for you is a 1099.
Right.
If they work for other people and they had like a lawn mowing service, then and they work for more than one person, then it could be a 1099 situation. But if they only work for you, it's pretty tough to say they're not an employee. And again, payroll tax is only up till age 18.
And the employee thing is all about whether you supervise and train and control and set their hours and all that type of stuff. So,
and again, realize they're paying payroll tax if you're hiring them, but you're also reducing your self-employment tax if you're self-employed. So it's basically a wash.
Good. Okay. So that's an example of doing something that'd be probably too aggressive, right? So that makes sense. All right, a couple more questions here. So last call, Richard. I'm I'm referring to the lazy CPA stating strategies are illegal out of ignorance. Rick. All right, so that makes sense. Rick, you'll do returns along with the consultation if requested. I'm assuming ? Yes.
Right. If I can look at their situation, I can suggest here's what you do. It's like a doctor. Here's what needs to be done. If you want me to perform the operation, fine. If you have your own CPA, and I realize there's a big bond. I'm not trying to break that bond. I just want to maybe get a little more proactive. They know these strategies. They probably know more than I do. I'm proactive and actually want to do it. Okay, that's the tough part. Just do it.
Yeah. A lot of people don't understand. They don't need more information. They just need to be told the right information and implement it.
Right.
Right. Richard said it's in the IRC. It's not aggressive or gray. Okay, good. Greg, any strategies to help a person who makes a high income but is an employee as opposed to a business owner?
Oh, there are some. Not as many. There's a high income person. You have some availability of, if you have incentive stock options or non-qualified stock options, rather than you exercising, paying tax on them, you gift them to your kids. They pay at their lower tax rate. Okay. There may be some opportunities to hire your child to help you if maybe babysitting. Actually, there's a tax credit for it. But again, if your income is too high, it doesn't work. I'd be lying to you if I said, but very few high income W-2 people that I see don't have some kind of tax shelter, like a side business, rental property, or have an interest in like a partnership. So that would enable you to be considered a business owner and actually utilize these strategies. Okay. So it's tougher. I'm not going to kid you.
All right. Well, okay. So on that note, last call for questions. And again, if you want to talk to Rick, who, just to run through his credentials one more time, founder of the National Institute of Certified College Planners, author of many books, including the 3-volume College Solution, speaker all over the country to trade groups, accountant trade groups, featured as an expert in Forbes, CNN, Newsweek, U.S. News, World Report, and everywhere that you would think. You've taught courses to financial advisors at UBS, Smith Barney, John Hancock, Franklin Templeton, you name it. This is a rare opportunity to speak to someone at this very high level. So if you are interested, either find the actually I'll put it up here one more time, the link directly to the form that leads to the application, or you can click on that blue button. And I got a couple more questions coming in here before we let you go. Polly, can the capital gain stock strategy be used with real property?
Sure. Yeah.
Any capital gain.
Anything appreciated, yeah. Or something, maybe you have equipment that's depreciated out and you sell it, that'd be at ordinary rates. That actually works better. So
Yeah, Polly is in the pub business, among others. So she probably has a lot of equipment, I would think. So
Pub like in publishing or pub like in beer?
as in drinking pubs,
Okay.
the good kind.
Okay.
Yeah. Funny. Yeah. All right. So there we go. So here we go. So, Richard says stop being humble. The other accountants are lazy. Okay. Yeah.
They get me in trouble with the
yeah.
boys, with the bro,
Yeah.
with the boys, yeah,
That's
the
so
brothers.
funny.
No, it's just being proactive.
Yeah.
They know this stuff. You just got to nudge them a little bit.
Yeah. He's not disagreeing. He's just not harping on it, I think. Yeah.
Okay.
All right. So let's sign off now. Thanks again for doing this, Rick. I really appreciate it. I know this is your second webinar today, so you must be tired.
Yeah.
You look strong. Yeah.
I got actually what tires me out. Andy forgot to tell you that I'm actually a legend. I'm a legend in my own mind, but what makes me a legend is I'm 70 years old and I have a 6-year-old. That makes me a legend, right, Andy?
That makes you something. I'm not sure if you're a young 70 though. That's yeah.
I just want to maybe hold this up, Andy. I don't know if they can see this or not.
Yeah, you've had some work.
Those strategies we just talked about.
When did you look like Carly Fiorina?
Yeah. Yeah. That was when we did one for Forbes, paying for college, holding down. We had 8 strategies, tax strategies there. I didn't give you number 8, and that's the best of all. So.
Ooh, clever. I'll show the book that you were promoting today earlier, just in case we have any nursing students here. You were showing
this is a new one by Springer Publication out of New York. It's for paying for your graduate nurses education without going broke. It was co-authored by Carl Buck and myself.
Yeah, good guy. All right, good. So that's your latest. All right. On that note, thanks everyone for joining us tonight. Thank you, Rick, again. And we will be around if you have any questions. Just shoot us an email, CEO@lockwoodcollegeprep.com. And otherwise, have a great night. Bye-bye.
Yep. Thank you.